What is the risk-free interest rate, and why is it important in options? Have you ever wondered what the risk-free interest rate is and why it matters in options trading? Let's break it down in a way that makes sense. The risk-free interest rate is the theoretical return on an investment with no chance of financial loss. In simpler terms, it is what you would expect to earn from a completely safe investment over a certain time. This rate is usually represented by the yield on government securities, like Treasury bills or zero-coupon Treasury bonds, which are seen as having almost no risk of default. Now, why is this rate so important? It acts as a baseline for all other investments. Since every other investment carries some risk, they need to offer a higher expected return than the risk-free rate to attract investors. To find the real risk-free rate, you can subtract the current inflation rate from the nominal yield of the Treasury security. This way, you ensure that the return compensates for any loss in purchasing power due to inflation. In the realm of options trading, the risk-free interest rate plays a significant role in how options are priced. Models like the Black-Scholes model use this rate as the annualized interest rate to discount the expected future payoffs of the option back to their present value. This reflects the opportunity cost of capital, which is the return an investor misses out on by holding the option instead of a risk-free asset. When interest rates rise, call option prices generally increase. This happens because the cost of holding the underlying asset becomes higher, making it more valuable to hold the option instead. On the flip side, put option prices usually decrease when interest rates rise. This is because higher rates lower the present value of the option's strike price payoff. However, it is important to note that the impact of interest rate changes on option prices is usually smaller than other factors like the price of the underlying asset, the time until expiration, and market volatility. Interest rates tend to change in small increments and not very often. Understanding how the risk-free interest rate affects options can help traders estimate option values more accurately, manage risk better, and make informed decisions about their trading strategies. This is especially true for longer-dated options, where the effect of discounting future payoffs is more noticeable. So, the risk-free interest rate is a key element in options pricing, influencing how option premiums are calculated and adjusted over time.